Imagine investing for 5 years. You save consistently, you buy stocks, you follow financial news, you do everything that seems right. But somehow, your portfolio barely grows. Meanwhile, someone with less money than you quietly builds serious wealth. The difference usually isn't intelligence, it isn't luck, and it definitely isn't having secret information. It's avoiding a handful of beginner mistakes that silently destroy returns. Today, we're breaking down the biggest investing mistakes beginners make. And the final mistake might be costing people more money than all the others combined. Investing looks simple on paper. Buy good assets, hold them for a long time, and let compounding do the work. But then reality arrives. Markets fall, news headlines become scary, friends brag about their latest winning stock, social media suddenly turns everyone into an investing expert, and that's where most mistakes begin. The first mistake is waiting for the perfect time to invest. Many beginners spend months or even years waiting for the perfect entry point. They believe a market crash is coming, so they stay on the sidelines waiting for a better opportunity. The problem is that nobody consistently predicts market bottoms. While you're waiting for the perfect moment, the market may continue moving higher. The biggest risk isn't investing at the wrong time. The biggest risk is never getting started, because time in the market usually beats timing the market. The second mistake is chasing hot stocks. A stock doubles, everyone starts talking about it, financial creators make videos about it, social media is flooded with rocket emojis and success stories. So beginners rush in, afraid of missing out. But by the time everyone is talking about an investment, much of the easy money has often already been made. Successful investors understand something important. Investing is not about buying what's popular. It's about buying assets that still offer value relative to their price. Popularity and profitability are not the same thing. The third mistake is ignoring diversification. Imagine putting every egg you own into a single basket. Now imagine dropping that basket. That's exactly what happens when investors put most of their money into one company, one stock, or one idea. Even great businesses can face unexpected problems. Regulations change. Competition increases. Economic conditions shift. Diversification may not be exciting, but it protects your future from one bad decision. Professional investors know that survival comes before growth. The fourth mistake is letting emotions control decisions. When markets rise, investors feel confident. When markets fall, they feel terrified. Unfortunately, emotions often push people to do the exact opposite of what works. People buy after prices have already risen because they don't want to miss out. Then they sell after prices fall because they're afraid things will get even worse. In other words, they buy high and sell low. Successful investing often requires doing what feels uncomfortable. That's why discipline is usually more valuable than intelligence. The fifth mistake is obsessing over daily market movements. Many beginners check their portfolio multiple times a day. Every small decline feels like a disaster. Every gain feels like proof they're a genius. But wealth isn't built over hours, days, or even weeks. It's built over years. Imagine planting a tree and then digging it up every day to see if it's growing. It sounds ridiculous, but many investors do exactly that with their investments. Long-term wealth requires patience. And patience has become one of the rarest skills in modern finance. The sixth mistake is investing without understanding risk. Every investment comes with risk. There is no such thing as a guaranteed return. The question isn't whether risk exists. The question is whether you understand the risks you're taking. Many beginners focus entirely on potential rewards. They see stories about massive gains and assume success is inevitable. Experienced investors ask a different question. What could go wrong? Risk management may not sound exciting, but it often determines who stays in the game long enough to build wealth. And now we come to the biggest investing mistake of all. It's not choosing the wrong stock. It's not buying at the wrong time. It's delaying the decision to invest altogether. Every year you postpone investing is a year that compounding loses the chance to work for you. Compounding is one of the most powerful forces in finance. It allows your money to generate returns, and then those returns generate returns of their own. Over time, the effect becomes extraordinary. But compounding has one requirement: time. And unlike money, time can never be earned back. The earlier you start, the easier the journey becomes. That's why successful investors spend less time searching for perfect investments and more time staying invested for the long term. The goal isn't to be perfect. The goal is to be consistent, because wealth is rarely built through one brilliant decision. More often, it's built through hundreds of simple decisions repeated over many years. If you can avoid these mistakes, stay patient, manage risk, and give compounding enough time to work, you'll already be ahead of most investors. And that advantage can completely change your financial future. If you want to become a smarter investor and build wealth more efficiently, make sure you're constantly learning, because the best investment you can make isn't always in the market. Sometimes it's in your financial education. And if you're ready for the next step, check out the next video where we break down one of the most powerful wealth-building principles